Is the stock market crashing? Are we going to see further doom and gloom throughout the rest of 2022? The word recession is on every news and media channel, which, without a doubt, allows fear to settle in, and all the usual questions then start popping up. What should I do with my money? Is my money safe? Should I remain in cash? Should I sell out for my current investments as my portfolio is declining? Should I just hold and hope for the best? Is now a good time to invest in the stock market, as plenty of stocks are going at a discount? The list of questions is endless, yet the answers are foggy and always unclear. And there is a good reason for that. The more confused you are, the less control you have over your money and your future, and ultimately, the less you will do about it. And this all stems from a lack of financial literacy. Our schooling system is excellent for building a career, but non-existent when it comes to managing our finances. We are responsible for getting on top of this in our adult life, which people are keen to do, but once you jump on the internet, it is often a case of information overload, and that then leads to analysis paralysis. The solution to this, guys, is simple. Learn to read charts, also known as technical analysis. In today's recording, we will look at the charts of the US and UK indices, and I will show you how to get a clear, objective, unbiased view of the markets, and if we are actually in a crash or if it is all just a lot of fear-mongering that we see plastered across our media channels. So if this recording helps you to up your investor game, don't forget to like, subscribe and hit the bell notification. My name is Zahir Anwari. I'm the co-founder of SublimeTrading.io. We have helped hundreds of private investors over the past 10 plus years profit from trends in the market through our simple to learn methodology. I also write for a number of publications, including benzinga.com, and I'm regularly invited to guest speak on how everyday people can skyrocket their stock's performance, focusing on the next 3 to 5 years. So before we get into the charts, just a quick word on technical analysis. As already mentioned, technical analysis is just a flashy term for looking at charts. It is an excellent way for busy, everyday people to make investment decisions. First of all, it is simple to learn. Unfortunately, the internet is cluttered with unqualified educators and quacks selling their quackery, which plenty of people buy into, looking for that magic formula to get rich, which always never works, and why trading and technical analysis ends up getting a bad name and is generally frowned upon. Look guys, if you're desperate enough to buy into rubbish, there is someone sly enough to sell you that rubbish. It is just a case of supply and demand, and unfortunately, there's plenty of demand for quackery to be sold. Here is the thing. It is easy to blame others when things don't work out. However, be accountable for your decisions and you will see a complete change. Remember guys, the journey least traveled is the one within. That was certainly the case for me. When I switched from looking at get-rich-quick schemes and being accountable for my decisions and switched to an investor approach, my results completely changed, as did my lifestyle and my general mood. I was happier, I was in complete control of my money and my financial future. So when it comes to taking control of your money, technical analysis and charts are the way forward. Technical analysis has a rich history that goes back to the dawn of the financial markets. It has been used by the greatest investors and traders for exceptional returns for decades. Put it this way, Warren Buffett averages around 20% a year using his model, which is value investing, which is complicated and time consuming. But Richard Dennis averaged over 100% a year using technical analysis and trend following, which is simple to learn and it allows you to manage your portfolio in minutes a week. It is this combination of looking at charts like a trader but holding positions like an investor that works so well for busy everyday people. This is what we call here at Sublime Trading the Phoenix Investor. Now, throwing compounding and learn to safely take advantage of leverage with spread betting accounts and CFD accounts, and you will see mind-boggling returns. And for us here in the UK, we are absolutely blessed to have spread betting accounts as they are free of capital gains tax. You heard correctly, guys, free of capital gains tax. Okay, so let's switch over to the charts and have a look at some of these techniques on how we can determine if the stock market is in a crash or not using technical analysis. You'll be surprised at what you learn today. Okay, so this is the typical 3-screen setup that I use when conducting my analysis. I have the monthly time frame in the top left, I have the weekly time frame in the top right, and I have the daily time frame down here across the bottom. What we're looking at here are candlesticks. So where you see green candlesticks, this is when the buyers have been in control, and when you see red candlesticks, that's when the sellers have been in control. The time frame determines how long that candlestick takes to complete. So on the monthly time frame, it will take 1 month to have a confirmed closing price for each candlestick. On the weekly time frame, it will take 1 week to have a confirmed candlestick, and then on the daily time frame, it's at the end of each day where we have a confirmed candlestick. Now, the reason why we like to use the higher time frames, the monthly, the weekly, and the daily time frame, is because we get a very clear picture of the history of the asset. So how well it's performed in the past, and that will give us a clear indication of how well it will perform in the future. We get a very clear picture of what the asset is doing right now, and then we can determine what the asset is likely to do going forward. If you move down to lower time frames, 1 hour time frames, 5-minute time frames, this is where you get into intraday territory, also known as day trading, and where it becomes very cluttered, very unclear, as you're really narrowing down onto these sort of small price movements. These small price movements get absorbed into the bigger picture, and it's where the bigger picture, the weekly, the monthly, the weekly, and the daily time frame, where we get a very clear idea of the market. In addition to that, it's where we do less work to make a lot more profit. And that's really where we want to be as busy everyday people. We've got a lifestyle, jobs, careers, family, hobbies, etc. We want to be able to manage a portfolio around our day-to-day. And that's really where the beauty of technical analysis and the higher time frames come into their own. So let's start with the S&P 500. The S&P 500 really is the primary indicator of overall market conditions. Whatever the S&P is doing is a very good indication of what the stock market as a whole is doing. So we like to look at the S&P 500 as our primary indicator. Now let's just go back in time. I just want to point out a couple of market conditions going back to this territory here. So this is from the high of 2000 to the low of 2002. So you can see there was a bear market, and if you look at that decline, that was a decline of around 50%. Then we had the recovery. So the recovery was from 2002 to 2007, where price came back to that high of 2000. This initial decline was when the tech bubble burst. This was when we had the financial meltdown, and this decline again to the low was around 57-58%. So these declines in the stock market was significant. Price then found a low point in March of 2009, and since that low point, the stock market has been on this huge run, the longest bull run in history, and you're looking at a bull run of around 620%. So that's a significant move to the upside. Now, if we look at this recent decline in more detail, at its low, price fell by 25%. In comparison to the bear markets of 2000 and 2008, when price fell by over 50%, the fall in price so far in 2022 is only 25%. Now, this is a significant drop, no doubt, particularly if you look at some of the tech stocks like PayPal, which I've looked at in the past, have fallen over 70%. Tesla, which I looked at yesterday, has declined by 50%. So no doubt there have been some stocks that have been hit pretty badly, and most of them are in the tech sector. But the S&P 500 itself has fallen by only 25%. Now, if we look at a little bit further in detail, we've got two markers here. We've got the high of last year and the low of last year. So this is the high of 2021, the highest price reached in 2021, and this is the lowest that price reached in 2021. If we look at current price action, it's trading inside these levels. So that in itself is a very good indicator that we are not yet in a market crash. It's important to understand that there's a difference between a pullback or a correction, which is what this is, and a full-on market crash, which is what we saw in 2000 and 2008. At the moment, we're simply in a correction. Now, if you look at the news, follow media channels, if you don't look at the charts and just simply focus on what our media channels are telling us, they always paint a very negative picture. But as investors, we have to learn to separate what our media channels tell us and focus on the charts, because the charts are a source of truth. This is price itself that we are looking at. So there cannot be any hiding from this. You cannot form any opinions on this. We can only look at what price is telling us and act accordingly. So for now, because price is inside these annual levels of last year, this is not a market crash. This is simply a market correction. If price breaks through the low of last year, then potentially we could see further weakness, and that's when we could be in a market crash as such. Now, of course, terms like this again shouldn't really instill fear in you. The challenge is that often people lack the right knowledge and the right tools. In today's day and age, we have access to spread betting and CFD accounts, and so if the market does decline further, we can actually short the market, and this means we can make profit when the market goes down. The challenge is knowing how to do that. That's really where training and tools and understanding comes in. But again, these are very simple techniques to learn. Okay, now if you move across to the weekly time frame, you'll notice that price, this decline that we looked at, is trading above the 200 simple moving average. Now, the 200 simple moving average is a proven indicator of the long-term trend. If we go back to before the internet, charts like this were drawn by hand. Old school traders didn't have the luxury of software. And so because charts were drawn by hand, they were very particular with the information that they put on the charts. The 200 simple moving average was a proven indicator of the long-term trend. So if price was above the 200 moving average, they would look for long opportunities. If price was below the 200 moving average, they would look for shorting opportunities. So if we actually go back, I'm just going to go back to 2008, guys. If you look at 2008, price declined to the 200 simple moving average, bounced off it, and then eventually broke through it in June of 2008, and then declined by a further 49% from the 200 simple moving average. So this is really a full-on market crash, and this is when we can consider potentially shorting the market. If we look at current price action in comparison, it's still above the 200 simple moving average. The trend is down. Yes, our trend filter is red. Price is trading below the 50 simple moving average. If we look at the bull run post-corona, it was above the 50 simple moving average, and it was above the 200 simple moving average. This was a very strong bullish period. However, this correction in 2022 has taken price below the 50 simple moving average, but it's still above the 200 simple moving average. When price is between the 50 and the 200 simple moving averages, this is really a territory or a period where you want to be standing aside and protecting capital. It's a concept that people generally don't understand, because we're conditioned to make money as a salary every hour, every week, every year. We generally swap time for money. When it comes to investing, people tend to think in the same way, whereas what you really want to do is shift your thinking. As an investor, you want to think in periods. There's periods where you'll make money, and then there'll be periods where you stand aside, maybe take profit, protect your capital, and then look for the next period of boom in the market. For now, this is really a period where you want to be standing aside, simply because price is between the two moving averages. Once it breaks below the 200 moving average, we could then start considering shorting the market. Now, if we go down to the daily time frame, if we look at price action, it's already below the 200, the 50 and the 20 simple moving averages. So the daily is looking bearish, but because the weekly is not confirming that just as yet, on the weekly we still have a bullish bias because we're above the 200 moving average. Once price on the weekly moves below the 200 moving average, and the weekly and the daily time frames are aligned, that's an important concept, are aligned. And also, guys, remember, don't forget, on the monthly time frame as well, once price breaks below the low of last year, once that happens, once price action breaks through these levels, we will then have alignment across all three time frames, and that's when we will be in a territory that we could deem this a bear market or a market crash, however you want to label it. For now, we really want to be standing aside. Looking at where price is finding support at the low of last year. What that means is that price has come to this level, and now the bulls are coming in and starting to push price up. A support level is like a floor. The bears came to this floor. The floor is holding strong. The bulls are coming in and pushing price back up again. And we can see that because so far in July, we've got a green candlestick, and also we've got a wick below last month's candle, because this was a long red candle all the way down here. The bulls came in, pushed price up, and now we're seeing the bulls still trying to work their way back up. If the bears come in and push price below this level, then we are in a bear market, and once price breaks through the 200 moving average. So there is some patience needed for now, and I hope this has really sort of opened up your understanding of how powerful technical analysis is. Okay, let's switch over to the Nasdaq. Now, the Nasdaq is painting a slightly different picture. If you notice, the Nasdaq is already below the low of last year. Now, I mentioned that the tech stock has really taken a beating, and the Nasdaq is a really good example of that because it's trading below the low of last year. But again, the S&P 500 is a primary indicator. So if the S&P 500 breaks below, that's when we want to consider shorting the market. The Nasdaq, yes, it's leading the way. But again, if you look at July, we are seeing bullishness. So potentially we could see price work its way back above this level, and this would then be a fake breakout. Crucially, on the weekly time frame, price is still above the 200 moving average as it is on the S&P 500. So again, we want to, even though price is trading below the low of last year on the monthly time frame, on the weekly time frame, price is still above the 200 moving average. On the daily, price is below the 200 moving average as well. So again, still, we don't have full confirmation of a bear market until price breaks below the 200 moving average. If we move across to the Dow Jones, very similar to the S&P 500, is finding support at the low of last year. So it's still trading inside the annual levels of last year. On the weekly, price is above the 200 moving average as it is on the S&P 500 and as it is on the Nasdaq. And on the daily time frame is very similar to the S&P 500 and the Nasdaq 100 in that it's trading below the 200 moving average. For now, again, we want to be standing aside until we get a clear picture of what price does with the 200 simple moving average and the low of last year. Once we get that confirmation of a break below these levels on both the S&P 500, the Nasdaq and the Dow Jones, because also in the Nasdaq we want to see price break below the 200 simple moving average, that is when the market is completely aligned, and we can then start considering shorting the market, or what we can then call a market crash, especially if price starts weakening further, falling by another 10, 20, 30, 40%, which is possible because we saw that in 2000 and 2008. Okay, guys, I hope that really helped you guys to understand the beauty and the power of technical analysis. It gives you a very clear picture of the market conditions that we're in. And whatever you hear on the news, it's important to stay on top of the news because we need to be aware of world affairs. Of course, it's good to have your news coming from different sources so that you have a more sort of balanced view of world events and not get conditioned by one sort of media channel that you're looking at. You need to know what's going on because you can then have sensible conversations with your friends and your family over dinner or whatever the case is. But you've got to separate that from the investor in you. And the investor in you will look at the charts, and the charts will then help guide your decisions of what kind of market conditions we are in. Let's just quickly switch to the FTSE 100. Now, we don't generally look at the FTSE 100. We look at the S&P 500 because whatever's happening in the US is generally a reflection of what happens everywhere else, because whatever happens in the US, the rest of the world follows. But let's have a quick look at what is happening at the FTSE. For those of us based here in the UK, we can see that in comparison to the US indices, the FTSE has just really been moving its way to the upside, particularly in 2022. Yes, I should correct that. Post-Corona through 2020 and 2021, the S&P 500, the Nasdaq, the Dow Jones, and the FTSE were all on this bullish run. However, since 2022, where the US indices have declined, the FTSE has actually held quite well inside a sort of area of consolidation. Last month was bearish, but it's still holding above that 7,000 round number. Now, here it is on the weekly, price above the 200 simple moving average, as it is on the US indices. On the daily, price is below the 200 moving average, again similar to what is happening on the US indices. So overall though, the FTSE is holding fairly well, and the 200 simple moving average is holding strong as support. It's really what happens in the US indices that guides our decisions. So we keep a close eye on the S&P 500 and then make our decisions from there. What we want to see ideally is price find some kind of support and then a move back to the upside, but we can only allow price to dictate that. Do not allow opinions to guide your decisions. There is a saying in investing which is to ignore opinions, including your own. Let the charts dictate, let price action dictate. So guys, I hope you found that helpful. Don't forget to like, subscribe and hit the bell notification. Where do you go from here? Go down into the description, click on the link. The link will open up into this scorecard. Are you ready to skyrocket your stock performance? Take the scorecard, guys, by clicking on this button. It will take you less than 2 minutes to complete. At the end of the scorecard, you'll get a wonderful report detailing your performance, but you will also get 30 days free access to the Hot Stocks Vault, where we do all the scanning and analysis for you, saving you thousands of pounds in scanner subscription costs and hours daily and weekly having to find these stocks yourself and share with you the very best 10 performing stocks every single week. See you in the next recording, guys.